Hello and welcome to this episode of Perspectives. My name is Chris Stegemann, Client Portfolio Manager, and today we're joined by Bill Campbell. Bill, thanks for joining us today.
Yeah, thanks for having me again.
So just by way of background, Bill is a portfolio manager on our U.S. Treasury team, as well as our global bond and emerging market local currency strategies, and more generally speaking, our geopolitical in-house experts. So given the volatility that we've seen as a result of the Trump trade policy, and really just tariffs being put on and off, it seems like the news cycle moves by the hour, if not the day. So I figured it'd be a great time to have Bill on to discuss the potential impact. And Bill, recently you wrote an article titled Assessing Trump Trade Policy. And it lays out a very interesting framework for how to approach such a fast-moving topic. So if you don't mind, just expand a little bit on the framework that you're using to approach this topic.
The genesis of the paper came about due to the fact that the rollout of trade and tariff policy so far in the Trump administration, we're only a couple of months in, has been haphazard at best. We've seen tariffs be announced, be pushed out, tariffs be announced and put on in the case of China. We've seen oftentimes what seem to be changing objectives. There's one date that I really want just to point out, and it's April 2nd. The president has asked that the U.S. Trade Representative Jamieson Greer provide a detailed report on global trade on that date. It is my hope that on that date we will get a lot more detail about the framework and the objectives that this administration is hoping to achieve. In the framework, I create two categories. The first category I view as a transactional category. And what I mean by that is tariffs being used for a negotiating tool, or tariffs that will have a duration of less than a year. After implementation, there can be a negotiating period between the United States and a country, or the United States and industry leaders, and an off-ramp to those tariffs can be achieved in a relatively short time frame. One example of those might be the national security IEEPA tariffs that have been announced, implemented, and then had carve-outs, but placed on Mexico and China. The rationale for implementing those tariffs is one, trying to deal with the drug trade, and reducing fentanyl movement into the United States, and secondly, dealing with an immigration problem and a porous border. And to me, those are two items that appear to be transactional. The structural side, I think, is what we're going to see coming out on or after April 2nd. I'm defining as much longer lasting, at least likely to last the duration of this administration, if not longer. A couple of examples would be, one, the reciprocal tariffs. The idea behind these reciprocal tariffs is to, quote, level the playing field for U.S. exporters globally. The idea that we have tariff and non-tariff barriers by many countries harming U.S. exports, into international markets. The goal of the administration is trying to normalize, that playing field for U.S. exporters. But when we listen to some of the rhetoric coming out of administration officials, talking about including items in these tariff and non-tariff barriers such as value-added tax. The value-added tax would be very difficult for countries to remove, as it's a revenue line item for those countries and part of an overall tax policy. So the idea that reciprocal tariffs would be quickly removed after implemented does not seem highly likely. One of the first things that President Trump did upon entering his administration was sign an executive order that created the External Revenue Service. And it is highly likely that the president is viewing tariffs such as the reciprocal tariffs, as well as maybe other types, potentially sectoral tariffs, as a revenue line item, a long-term revenue line item, for the U.S. budget. And when we look at the budget that's being pushed out in the United States at right now, somewhere around $4.5 trillion, if he is planning to use tariffs as a new revenue line item, that would then need to be sustained over the long term. The Trump administration has had a stated goal that they're looking to bring more production away from international markets and back to U.S. markets. Obviously, this can take time, and in some cases, it may not be feasible. So on sectoral tariffs, I think there are going to be elements where these are long-term tariffs that are put in place to try to incentivize more companies to come and produce inside the United States. But then there's also probably transactional elements where companies who agree to come and produce more goods in the United States may be exempted from those tariffs. So I call that a hybrid category where some types of tariffs could be categorized in both of those categories. Obviously, the near-term implication of transactional tariffs allow for a much more tactical trading view when you look at the implementation of those tariffs and the potential for negotiation, versus when you look at tariffs in the structural bucket. I think you need to project out, obviously, a much longer time frame.
Yeah, I think that's a great point, in that not all tariffs are the same, and it is such a fluid situation. So at least having that framework to approach it as we move forward. All post-election gains have been wiped out. We've seen rates rally. And really, February 19th, I think, was all-time high on S&P, and now we're down almost 9-10% since. So the question from this point forward, or at least as of today's filming, is what are the potential market implications, whether it be growth, rates, as we move forward here?
Well, I think when we think about market implications, one thing that we need to address at the outset is there's a difference in sequencing of policy between the first Trump administration and this Trump administration. The first Trump administration was able to get through tax cuts, deregulation in the first couple of years before implementing trade policy. This time around, trade policy looks to be sequenced first. And the problem that we're bumping into right now is trade policy has a tremendous amount of uncertainty around it. The longer uncertainty and questions exist, the harder it's going to be for leaders of business to be able to do capital planning and be able to make business decisions. It's going to be difficult for investors to make long-term investment decisions. And these questions, that remain outstanding, fall around, I'd say, several pillars. The first pillar is duration, and the real question, and that's where we come back to the framework that I presented, is how long will these tariffs, be in place? A second source of uncertainty is the layering risk, which we're starting to see. The first element is something that we actually are seeing this morning on March 13th, is the president has come out and threatened 200% tariffs on European alcoholic exports to the United States. The reason for that? Europe issued retaliatory tariffs yesterday on $28 billion worth of U.S. goods to retaliate against the U.S.'s tariffs on steel and aluminum. So we're starting to get a tit-for-tat layering there. If we assume that tariffs are just a one-off policy adjustment, just a one-off price adjustment, that can be digested by the markets fairly succinctly. You'll have a one-off price adjustment on the overall level of prices, but then when we go out a year, the price changes will have reset to a new equilibrium. We'll also have a one-off shock and to growth and the growth outlook for particular sectors. But once known, that can then be managed through and adjusted around. If instead we see a layering of tariffs one after another, so you put on April 2nd reciprocal tariffs, then sectoral tariffs come on. Then we see things similar to the IEEPA tariffs, the 25% on on Mexico and Canada that we saw. Let's say for other policy reasons, tariffs are implemented, maybe for currency negotiation, tariffs are implemented. All of this increases the uncertainty to markets and makes any type of capital planning and capital expenditure very difficult. And obviously that's going to weigh on margins across companies. It's going to weigh on companies' ability both to hire but also retain employees and to plan new investment. And then finally, details matter. One of the big questions about that we have yet to have answered, and I'm hoping is going to be answered around April 2nd, is what type of exclusions are going to be provided to companies that do agree to increase production in the U.S. or build out new facilities in the U.S. Will those companies have to pay tariffs up until that new facility is opened and up and running, and then they'll be rebated for tariffs that they've paid? Or will you get a waiver up front just for the commitment? Also, is it going to be for all goods produced by that company, or is it a subset of goods that's coming out of either the United States or trading partners that the U.S. deems as friendly? And obviously, the implementation of tariffs and rewriting of global trade policy, puts all of those, geopolitical reasons to, bring trade back from China to our local neighbors in question, and keeps uncertainty that we thought we had, maybe for, especially for the outlook for Mexico and other Latin American countries, that keeps uncertainty around that outlook as well, as far as, is that a growth driver, or now is trade a headwind to global growth?
Uncertainty seems to be the main theme, and hopefully we'll get some clarification on April 2nd. And again, continue to monitor the situation. I think we should finish off with opportunity, though. Europe comes to mind. Europe's been outperforming U.S. Year to date. It seems to have underperformed U.S. for over a decade. U.S. exceptionalism comes to mind. And I think in my conversations with clients, I've been asked about non-U.S. investing more in the last, call it 2 weeks, than I have in maybe the previous few years combined. So any opportunities or offshoots of all this that you're keeping an eye on from an investment standpoint?
Europe is undergoing currently a sea change in their approach to fiscal policy. Following the meeting between President Zelensky and President Trump in the Oval Office, Europe realized that the assumption of a U.S. security guarantee pretty much across the globe, but towards Europe, can no longer be taken as a given. And what we have seen is a dramatic overnight change in parliaments across the European continent, as well as the European Council itself, coming together to say there needs to be a build out of defense in Europe, and in conjunction with that, we're going to see a build out of infrastructure. And the only way to do that is to jettison the rules, the fiscal rules that they had been abiding to for the past several decades of trying to stop the growth of debt-to-GDP pass and running fiscally austere budgets, to ones that are now going to be much more forgiving of investment spending, especially in defense and infrastructure. One of the key features of the global economy prior to the Trump administration had been the idea that U.S. exceptionalism was well entrenched, meaning U.S. growth prospects were higher than those of all of its developed market peers. And when you think then about margin growth and companies' abilities, to be able to continue to grow earnings and have new prospects for better business opportunities, the United States really was the country that the lead horse in that race, and that caused a lot of investment to come out of the rest of the globe into the United States. And one thing that we have talked about in the past is the large deficit that the United States runs in their net international investment position. There's more global savings that came into the U.S. than U.S. investors buying foreign assets. I think that we may be at the beginning now of a tip, and we had talked about this before, that we have been watching and waiting for what would the catalyst be that could potentially turn the tide, on that flow of capital. And I think that the potential for Europe to underwrite, a industrial build out driven by defense and infrastructure has the real chance of doing that. And remember, Europe is starting out from a very depressed starting point. They dealt with the Russia-Ukraine war, which caused an energy price and an energy crisis across the continent. We've seen a hollowed out, German and Northern European manufacturing sector that's lagged. And what we're seeing just over the past couple of weeks is an invigoration of all of those depressed sectors and industries. It's still very early. We need to see, the U.S. policy of trying to reindustrialize America obviously presents a challenge to that. But, Europe moving away from its path of fiscal austerity, is something that, we need to take and, keep a close eye on.
Well, thank you, Bill. I appreciate it. We'll certainly be keeping our eye on all things tariff related and potentially some investment opportunity outside of the U.S. So thank you again for joining us today. If anyone has any questions or if you'd like to find the white paper that Bill produced on this topic, just go to doubleline.com or reach out to us at info@doubleline.com. Thank you very much.